Welcome to this session. In this session, we will continue our discussion about the development of banking structure over time, and subsequently we will discuss the banking structure in India. So, one of the changes happen in the US is that the restriction on branching. That means there are two types of banking we can classify based on the branch. One is called branch banking and the other one is called unit banking. So obviously, as you can guess, branch banking means banks are the main bank. They are allowed to start branches across the country, right, within the county or within the state and across the country. So for example, in India, the State Bank of India, you know that it has a central in the head office. It has started. It has several branches across the country, right? That in each state and each district, you can see that there is branch for SBI, and same for other banks as well in India. But in contrast to this, there is called another banking structure is called unit banking. In the case of unit banking, they are not allowed to open branches in other sites, in other places. So it's called unit banking. So normally we make a classification of branch banking and unit banking. So in the US, there are restriction on branching. They are not allowed to open branches across the country. So but that actually led to the presence of so many commercial banks in the United States. So each state had its own regulations on the type and number of branches that a bank could open within a state, for example. So of overall, there are policy interventions to ensure that banks are not opening branches across the country, and it forced all national banks to conform to the branching regulation of the state in which their headquarters were located. However, as compared to that, in India, we know that India we have branch banking, and India has only, you can see that if you visit the Reserve Bank of India website, you can see that India has only 36 commercial banks and 46 foreign banks, but all of them have several branches across the country. So that means only few number of banks in India. At the same time, in the US, you can see that there are more than 5,000 banks in the US. So this is the number of banks in the US. Is 5,757 as of this year. So we can see that actually the difference, huge difference in the number of banks in the country. So when we discuss this, the number of what is the implication of branch banking vis-a-vis unit banking, in one of the session in the forthcoming session, we will see the nature of competition. So you obviously know that if there are large number of banks in a country, a large number of banks in a market, that means large number of participants, that is very competitive, right? So let us see that what is the likely implication of the number of banks in the financial market, whether it's promoting efficiency, whether it's really contributing to the health of the financial system. All this we will discuss in appropriate context in one of the session, the forthcoming session. So let's now proceed the discussion, the structure of the banks. So response to branching restrictions, mainly there was bank holding companies, and the other one supported by the IT revolution is the ATM. That means even without branch, if there is branching restriction, they were allowed to start. That means ATMs throughout the country, so that actually in practically is serving as a branch, right? So it's possible due to the development in IT. Then there is called thrift industry. It's happened because of over time it's happened. In the thrift industry means mainly they are not banks, they are called savings and loan associations, mutual savings banks and credit unions. So these are closely parallel. The regulation and structure of the thrift industry is closely parallel to the regulation and structure of commercial banking industry. What is savings and loan association? These are chartered by federal government or by states, and most are members of federal home loan bank system. Then called the deposit insurance is provided by SAFE for savings and loan association. So as you know, these are not banks, but almost they serve the role similar to banks. Then there are mutual savings banks where most of them, more than 50% are chartered by states and regulated by state in which they are located. Then comes credit unions. Credit unions are tax exempt. They are tax exempt and chartered by federal governments or by states. These are regulated by the national credit unions. Then another classification about the banking structure we can make about investment banks vis-a-vis merchant banks. So by now you are familiar what is meant by investment banks. In theory, investment banks and merchant banks perform different function, but not always in practice. Investment banks traditionally only participated in underwriting and selling securities in large blocks. They facilitate mergers and acquisition through share sales and provide research and financial consulting to companies. And merchant banks primarily perform international financing activities such as foreign corporate investing, foreign real estate investment, trade finance, international transaction facilitation, etc. So merchant banks also provide issuings of letters of credit, transferring funds internationally, trade consulting and co-investment in projects involve trade of one form or another. So with this, now let us see the structure of Indian banking system, and this actually most of the point that we are discussing here you must be familiar with this, but let us put it in the context and to see what are the recent developments, what are the overall structure of banks, Indian banks, and how in the forthcoming session we will be in a better position to compare then how Indian banking system is going to affect the financial structure, financial system of the country. So coming to Indian bank, the definition given by banking as per Banking Regulation Act of India, this is actually in line with the normal banking definition. This is the formal definition given by Banking Regulation Act of India. So the Reserve Bank of India 1934 and the Banking Regulation Act 1949 and with the further amendments govern the banking operation in India. So you can see, you also aware that banks play a key role in India's financial system and underpin economic growth. Banks have been playing a key role to ensure financial inclusion and to bring the public into the monetary economy or the financial sector in order to monetize to bring increase the level of economic activities and the credit savings and investment activities. However, you are aware that during the 2010s recently the health of Indian banks deteriorated significantly, and especially in terms of non-performing assets, and a subsequent decline in credit growth contributed to the slowdown in economic activity. Before we proceed further, I would like to urge you, you please visit the website of Reserve Bank of India where you will get ample information about the banking structure in India, what are the developments over time, what are the policy measures taken by Reserve Bank of India in order to promote the banking system in India, in order to regulate the banking structure, banking system in India, and you will also get lots of information about the monetary policy and what are the different tools used by Reserve Bank of India to ensure a sound banking system and also to ensure macroeconomic stability and promote economic growth in India. And in addition, you will also get in the RBI website there is some data bank as well about key economic variables including banking sector as well, and I would suggest you please visit the website and make yourself familiar with various aspects of Indian banking. So coming to the banking structure in India, banks can be broadly categorized as commercial banks or cooperative banks. Within that, there are another broad categorization further, but that is called scheduled banks. You might have heard about it. Scheduled bank and non-scheduled banks. So all banks which meet specific criteria are included in the second schedule to the RBI Act 1934, and these are called scheduled banks. These banks comprise scheduled commercial banks and scheduled cooperative banks. So about the scheduled banks, they are entitled to special facilities like refinance from RBI, At the same time, inclusion in the schedule also comes with the responsibilities of reporting to RBI and maintaining the percentage of its demand and time deposits as cash reserve ratio. So, most of the regulations and some of the tools used for the monetary policy as part of monetary policy, these are actually implemented through the scheduled banks. Then called the non-scheduled banks, not mentioned in the second schedule of the RBI Act. There are many non-scheduled state cooperative banks and urban cooperative banks as well. But I want to say that actually the scheduled banks are the prime pillar of the major pillar of Indian banking system, as well as through which the Reserve Bank of India influence the money market and also using it tools of its monetary policy is also directed mainly through the scheduled banks. This is a screenshot summary of structure of Indian banks, that the RBI, that the Bankers Bank or Apex Bank, then commercial banks, cooperative banks and development banks, and these are all that the nationalized, private, etc. So, these are, I think I am sure you are familiar with this structure, this content. So, just to summarize this, RBI, public sector banks and private sector bank, and you know that Indian banking system is dominated by government owned public sector banks, which account for around 60% of commercial banking system assets. And understanding whether what proportion is public sector and what proportion is private sector, this is actually important when we discuss the health of financial system of a country. So, in one of the session we have seen that if the country, especially most of the low and middle income countries, their banking system is dominated by public sector banks, and you know that public sector banks they are actually forced to invest in government bonds, and that may not be, for example, the best way of investment. And not only that, that means that may not be the best way of the use of their funds. So, there are often asked, the public sector bank will be often asked to make prioritized sector wise loans, for example, agriculture loan or small scale industry loan, small scale industry, small scale enterprises, financial loans to small scale enterprises, etc. That may not be the right or efficient investment decision for a bank if you look from a efficiency point of view, but maybe an equity point of view, maybe that may be justified. But these are that all actually important when we look at the financial health of a country. So, in this context we need to see Indian public bank is primarily dominated by public sector banks. Then there are state cooperative banks, then development banks. These are all the development banks in India. So, let me show you the list of scheduled commercial banks. So, these are the public sector banks, scheduled public sector banks, 12 at present, 12 scheduled public sector banks and 22 scheduled private sector banks in India till date. And these are the scheduled small financial banks. You can see there are 12 scheduled small finance banks, and these are the scheduled payment banks that I think again you are familiar, that the Paytm, India Post Payment Banks, Fino Payments Banks Limited. Also I am showing you the list of scheduled foreign banks in India. Nearly there are 46 foreign banks, scheduled foreign banks in India at present. So, about commercial banks, because most of our discussion is confined to commercial banks. So, commercial banks comprising public sector banks, private sector banks, foreign banks, they represent the most important financial intermediary in the Indian commercial financial system. So, the largest commercial banks in India is the State Bank of India, as you are familiar with it. So, let us see what is commercial bank, what are the commercial banks. So, by now you are familiar with it, but let us put it in Indian context, what are the main functions of commercial banks. So, the primary functions, they are acceptance of deposits, and you know that there are two broad category of deposit. One is called demand deposit or demand liabilities, another one is time deposit or time liabilities. So, coming to the demand deposit, you are familiar again that the savings bank account and current account. So, in other countries it has been called as checking account. where you are allowed to write a check. The current account holder is entitled to issue a check. But in India, you know that the savings bank account holder also, if you maintain minimum amount in the bank, and you will also be given checkbook, and you are allowed to issue checks. Then coming to fixed deposit account, I am sure we already discussed this point in one of the previous session, that is with a time period in the investment. And recurring deposit account, that is actually invest in a regular interval, say monthly, that is called recurring deposit account. Then loans and advances, banks give loans through loan account, opening a loan account. Then also give advances, this is a credit facility, that's cash credit with collateral. And also give overdraft, that mainly this facility is given to current account holder, allowed to withdraw more than the amount of credit balance in his or her account. It's a temporary arrangement, that means they are allowed to draw over than whatever they are having with their account. So there are standard overdraft, that means no collateral, and other with a collateral. Then banks also engage in bills discounting, the concept by now you are familiar already, which we discussed in previous class sessions. So in addition to the main functions of commercial banks, they also do perform several secondary functions as well. This includes agency function, that means collecting receipts, making payments, buy and sell securities, and act as the trustee and executor of the customers. Perform this. These are all the agency function done on behalf of their customers. So in addition, banks also perform several general utility functions, that includes issuing letters of credit, travelers checks, underwriting shares and debentures, safe custody of valuables, that is locker facilities, ATM, providing credit informations, etc. And other function that we will be studying in the context of when we discuss central banking, we can also see that banks play, especially the scheduled banks, play a key role in creating money supply. In the process of money supply also they play a key role. And one of the development happened in India in 1969 was the bank nationalization. So prior to that, the nationalization of the Imperial Bank of India in 1955 by SBI India Act was happened. So SBI was made to act as the principal agent of RBI and handle banking transaction of the union and state governments. And in 1959, SBI associate, that is 7 subsidiaries of the SBI were nationalized by the SBI Subsidiary Banks Act of 1959. So in 1969, 14 major private commercial banks were nationalized. So you know, these are the banks nationalized in 1969. So one of the main objective of bank nationalization was to ensure the wide outreach of banking services across the country. That is to ensure the outreach at the grassroots level, at even the remote village level. The banks were nationalized and they were encouraged to open branch in rural areas and remote areas. In 1980, 6 more banks nationalized. These are the bank's name that's nationalized in 1980. Another structure, in addition to commercial banks, we have cooperative banks. The rural cooperative credit system in India is primarily mandated to ensure flow of credit to the agriculture sector. These banks play a vital role in mobilizing savings from the ground level, that is the village level, mobilizing savings and stimulating agricultural investments. It comprises short term and long term cooperative credit structure. So the short-term cooperative credit structure operate with a three-tier system. One is called primary agriculture credit society. So that means normally primary banks, primary cooperative bank also we can say. Shortly we people say that primary cooperative bank that you can see in your town or village. Especially in your village you can see primary cooperative bank, and it has three-tier system. So that is at the bottom level you can see primary banks. Then at the district level they are linked to the district banks. This is called central cooperative banks, and the central that the district banks then they are connected to the state cooperative banks, that is at the state level. So the primary cooperative banks at the also referred to the urban cooperative banks cater to the financial needs of customers in urban and semi-urban areas. That means in addition to cooperative banks in the rural area, we have cooperative banks in the urban area as well. Then another developments in Indian banking system is the setting up of regional rural banks. One of the thing about the commercial banks, commercial banks they have better efficiency because of the managerial technical know-how expertise they are having. Obviously any bank if you go, the technical efficiency, managerial efficiency they are having, so they are considered as efficient, but at the same time that they have very poor outreach. Especially if you see, you cannot see the branch of big banks in rural areas, remote areas and all, because when going with efficiency they prefer towns and cities, and even the village also little bit, it should be little bit relatively well developed. So at the same time cooperative banks, what we can see that you can see the nook and corner of the country, everywhere there is cooperative banks. So they have better outreach, but that they are less efficient. That means the efficiency, suppose if you see most cooperative banks, they don't have the ATM facilities, they don't have the electronic banking facilities, and because of that and all, that they are all because they are working at a very small scale basis. They actually miss the economies of scale and economies of scope. So because of all these they are less efficient. So in order to overcome that, because you can see commercial banks have the advantage of being efficient, cooperative banks have the advantage of having better outreach. In order to, the idea came up in a way that the better things, that the efficiency of commercial banks and the outreach of cooperative banks, it should be brought together, and as a result RRBs were born through Regional Rural Banks Act of 1976. So under the RRB Act, 50% stake in regional rural banks would be with the central government and 15% with the state government concerned, and remaining 35% is with the sponsor banks. That means one of the commercial bank, one of the bank will be sponsoring their respective regional rural bank. So these are the list of regional rural banks. And in addition to RRBs, there is development banks. Development banks, a bank may be defined as a financial institution concerned with providing all types of financial assistance to business unit in the form of loans, underwriting, investment and guarantee operation in the industry and in the manufacturing and in agriculture sector. So these are specialized institutions as compared to commercial banks. They actually serve several purposes, several functions. I have listed all of these things here for your understanding. So these are the list of development banks in India. These are the list of development banks, including for example IFI, IFCI, IDBI, NABARD, and Exim Bank, that is for Export Import Bank. That is to support fund export and import business in India. In addition, we are also, you might have heard about non-banking financial companies, which are not banks but which accept deposits and extend credit like banks. They are actually not just the finance companies that the general public is largely familiar with. It terms also entails wider group of companies that are engaged in investment business, insurance, kit funds, Nidhi, merchant banking, etc. All are though not under the direct regulatory purview of Reserve Bank of India. So you can see there are large number of NBFCs working in India. So, one of the concerns with the Indian banking system recently is the non-performing assets. That means an asset of a bank turns into non-performing asset when it ceases to generate regular income such as interest, etc. for the bank. Banks have to classify their assets as performing and non-performing assets in accordance with the RBI guidelines. So, recently you might have seen that there are lots of discussion with regard to the non-performing assets in India, and the classification of NPA, recently RBI has come up with lots of guidelines. So, in this session we have completed mostly our discussion was confined to the banking structure in India, banking structure and structure in India, where we discuss in terms of commercial banks, cooperative banks, regional rural banks, and development banks, and then also we discuss some of the non-banking financial companies as well. Thank you.